Hey guys, it is 7/19/2023. A lot going on right now, exciting stuff. Wanted to bring you up to date. It's good to have some good news for a while. So let's talk a little bit about what's happening in the market. Inflation. So in some areas of our economy, inflation has gone down some, according especially to the folks in charge, CPI and all that other stuff. When we look at this, there's a lot of different components with inflation. I thought just for a few minutes, I might talk about some of the things that impact a lot of the things that we're looking at, and just in general, look at the market. So let's go to my charting system, since that's what I like to do, and we'll just kind of blaze through the things. So one of the components for inflation, obviously, is real estate. So this is Fidelity's real estate index. So if you look at where we were 12/31/2021 and think back to prices for real estate, prices were very high. They're still high, but prices are dropping some in the United States from where they were. Very tough to buy a house back then. Still pricey, but not as bad as they were. Now, what I'm looking at is a chart that goes back for 5 years. So you can see that we're pretty much where we were about 5 years ago on overall real estate. Now, this is not just residential, so you've got to think a little broader. This has some commercial in it as well. If we looked at the residential piece, it has a similar chart pattern to it. You can kind of see that it has dropped from its high again right around the first of last year. All right, so off of real estate, let's look at another component, which is oil. So this is not necessarily the price of oil. This particular investment buys oil futures, and it's as close as I can get to the approximation of what's happened to the oil prices. So if you go back here to October of 2018 and then look at prices today, the oil prices are lower. They were substantially lower in 2020, in part due to what OPEC was doing. They controlled the prices back then, and they dropped prices a lot. So oil prices are moderate at this point. We're not seeing those highs that we had maybe 1 or 2 or 3 years ago. The other side of that is we're not seeing super low prices either, like we did from 2017 to about 2020. Again, a component of inflation. You know, there's food and other things in there, but just understand these things all work in concert. So let's look at the dollar. And again, this is not the price of the dollar against the yen. This is just an indicator that I can use when I'm watching the dollar. And if I wanted to buy the dollar, I could use this particular Invesco dollar index to buy, you know, exposure to what the dollar does. So the dollar fluctuated around, peaked right here. A lot of things peaked right at this range, but this was 9/26/2022 when the dollar peaked, dropped down about 11%. Now it's just kind of bouncing in this range, but that's not a low if you're looking at a 5-year chart. It is a low if you're looking at a 1-year chart. So the dollar is relatively high against the rest of the world. All right, so let's look at the indexes because we're looking at the stock market. It's fun to talk about this, by the way. So here is the S&P 500 index. This was January of last year, and the market dropped as low as 27.5%. It was a rough period of time where we made lower highs significantly all the way through, and then the market has rallied back. So now we're not down 27. We're down from the last, we're down from the last market high, about 5%, something like that, 5.1. And we'll probably move a little higher. You know, the trend is your friend, so don't fight it. Right now, the markets are trying to move higher. I'm all in. There's a lot of money out there printed and on the sidelines. And so might as well take it while we've got it. Let's participate in those markets. So for a lot of the models that we use, that's what has happened. We have shifted to equities. All right, let's look at Europe, Australia, and the Far East. And I didn't bold that line out, but at one point, this was down about 33%. So rugged if you bought in up here, but now those markets are starting to recover just as we are. And now they're down about 10, 11-ish% from the last market high. So again, a pretty substantial recovery from the bottoms. All good there. All right, let's look at emerging markets, which you would think would have a little more issue, because in this index is Russia and China. That's not just what's in there, but those are two major components. So that index from its high, and that date was 2/16/21, went down about 40%. And now we're getting some recovery back in there, mostly as China's economy has come back online, but India's in this index as well, so recovered back quite a bit. It's down 26 and change from its high. But if you look a little further back and look to the left, this is sort of the range that index has been trading at for really about a 5-year window, excluding COVID and excluding a big money injection into the economies. All right, big deal. Let's look a little further, and we look at the bond market. Well, interesting chart. I've shown this many times. The reason why the price of bonds has gone down is because in this index are many low coupon or interest paying bonds. If you had a bond that was issued 2 years ago or 3 years ago in 2020, it probably paid less than 1%. Today, you can buy bonds. I'm looking at the US Treasuries right now. So a 1-month Treasury bill pays 5.273. And a 3-year pays 4.345. So you can see, you've heard that inverted yield curve many times. That means that the interest rates for a shorter maturity are really higher than the ones that are way out there for maturity. So a 30-year Treasury pays 3.896, and you go, well, I'll buy the short one. And right now that makes sense. But what will happen eventually is, as they stop raising rates or drop rates, the short-term stuff matures, and you will no longer be able to capture the 5 or at least 4.7 yield. So about the inflection point's about 3 years. You can get a 3-year Treasury, and the bonds, the regular corporate bonds, will be similar to this. A 3-year Treasury is 4.348 today, and you have to say to yourself, what's the market telling you? And it's telling you that they don't believe that interest rates are going to stay up forever, so the longer maturities are not that high. But anyway, prices went down a lot. Now is a time to add some of the bonds into your portfolio. Don't run away from a bond because it's not a stock. A lot of folks have never really understood what the bond market is, because for the last 15 or 20 years, it really hasn't been a very positive thing to own. I mean, it's not a negative perhaps, but there really was no reason to buy an interest-paying instrument because it didn't pay much. But now all of a sudden, if you can get in the high 4s or low 5s for something that will actually pay you interest, that you take the money, it's not something that's just reinvested. You can buy a real bond. It's kind of cool. You need to have some of that in there as your baseline to protect you against volatility. If you bought them up here, not so good. But if you buy them down in here, those prices and the yields, are pretty darn good. All right, so that's your bond market. Let's look at gold for a second here, because, always the TV saying, hey, the market's going to die and the world's going to come to an end, and you need to buy this yellow metal because it'll make you better. I'm not against gold. If you want to buy some gold, go get you some gold. But my point is, gold is only worth what somebody else will pay you for it. It doesn't have an earnings potential. It doesn't have a dividend or interest payment. And so it's basically, is the price up or down? And the price is sort of level. If you look at where we are now and go back to right here, which was 2020, 7/23, 2020. So 3 years ago, we're about the same spot we were 3 years ago. So wait until the prices drop if you want to buy the commodity, and go to a good, reputable metals dealer and buy yourself some gold, if you want some. But this won't be your savior. I'm just telling you, if something weird happens, that's the Armageddon stuff, and you need food and guns and bullets and band-aids and all that sort of stuff. All right, about done. So we've done everything in here. Yeah, that's about it. So as we're looking at the world, the biggest, strongest growth thing that we have right now is this AI market. So the closest I can get to finding something there would be the technology index. So the technology index, I'm using Fidelity's. They're all about the same. They have the same stuff in them. It was the worst performer in 2022, losing 37%. But now, guess what? We're back, mostly because of AI. So you can see we're only down about 1.3% from the all-time in the history of the world market high that we had back in December of 2021. So exciting stuff in here. Technology is a very volatile sector, but guess what? When it's moving up, you need to pay attention to it. Don't be afraid of it, understand it. So at this point, stocks are firing pretty well. We're seeing more participation in the other sectors of the economy, not just tech, but that has been the stellar performer so far in 2023. Understand that there's a lot of cross currents here. There's talk of a recession. There is more inflation than 3%. The variables, again, two big ones will be housing and energy, which will be oil and natural gas, the derivatives of that. So just understand, if those prices change much, you can see inflation and CPI change quite a bit. So those are hard things to really gauge at this point, because they went up a whole lot. And now, are they going to go down, or are they going to stabilize and move back up? So stay tuned. We'll pay attention for you. If you have questions, as always, give us a call, 336-448-1086. And with that, I bid you a good day, and I hope you enjoy the rest of your month.